Hello everyone and welcome once again to another edition of Skybound Capital's podcast series Under the Macroscope. As always, we welcome your feedback. We thank you for your feedback on past podcasts and suggestions for future topics to be discussed. And also we welcome questions to members of our research team and those who have appeared as guests on the podcast for more information on their specific area of expertise. Now, obviously dominating the global headlines at the moment for good reason is the war in Ukraine and perhaps more specifically the knock-on effect to various macro factors in global economies. In recent podcasts, we talked about soaring energy prices across Europe and the spike in oil prices globally, the knock-on effect of that to supply chains across the world and the cost of just running a commercial or a recreational vehicle. Things have got very, very expensive. But another topic that has regularly come up is that of real estate, the effect of COVID, the work from home strategy during COVID and how that's affected both commercial and residential real estate. We've had a conversation about this with the chief strategist in the London office for Skybound Capital, Jabir Sadawala, on a number of occasions. And today we welcome to the podcast from Switzerland, the CEO of RE Capital, Newman Leach. And Skybound Capital has a very close association, long-standing association with RE Capital, which has projects across Europe. And Newman, great to have you on the podcast today. I'm going to start by asking you about another theme that Jabir has regularly discussed on the podcast, and that of rising inflation globally and interest rates creeping up, albeit very slowly, and the effect of these two things in particular on the global real estate market.
Good morning, Matt. Thank you for having me. Look, indeed, the main topics of the day as we entered 2022 were really around inflation and the rising costs. You know, as we started coming out of COVID in Q3, Q4 last year, we saw a dramatic increase in pricing across the board, with inflation rates looking to hit around 5.5% in the UK, projected to end up anywhere between 3.5% and 4.5% across Europe. We're already in March, and those figures have been drastically revived with the conflict in the Ukraine, and now we're looking at possibly inflation rates of around 8% or higher. And that's really a combination of a number of factors. One is obviously your constrained supply as manufacturers started switching on the lights again. Your increase in energy costs, which has now been exacerbated in the Ukraine. And that's obviously causing a concern in the real estate industry because of rising costs. Steel has gone up 30%. Labor's gone up. You've got a constrained labor market, so wages are rising. So all of that obviously doesn't bode too well for the real estate market. On the other hand, the real estate market is really a hedge against inflation. So I think that's the key point, how to tame inflation and how to succeed in an inflationary environment. And real estate is one of those asset classes that we believe will outperform in an inflationary environment.
So notwithstanding those challenges that you've highlighted, why then is real estate remaining a compelling asset class in this environment?
Well, as goods and services rise, as the price of assets rise, the theory is that your real estate will rise as well. But that's caveated, of course, it depends on how you manage your real estate. So that's really referring to the cork on the top of the ocean that's bobbing up with inflation. And that only is predicated on the assumption that you control your revenue stream. So if you've got an asset that's generating a yield, to the extent that you're able to lock in a covenant with variable rates that's CPI linked, of course, then you'll be protected against inflation. And when you take a look at how properties are valued, typically looking at your net operating income divided by your capital rate percentage, and that's generally how you get your value of your property. And in an increasing interest rate environment, the trend, although they're not directly correlated, is for cap rates to soften, which means the value of your property goes down. But if on the one side of your equation, your operating income continues to rise, you'll be able to stabilize and maintain the real value of your underlying asset. But again, that's predicated on making sure you can control the revenue streams of your assets. So in an environment where you're a developer and you're selling units, you're selling houses or apartments, you need to make sure that you're not pre-selling too many your units in advance. And similarly, when you've got a leasing arrangement, the leasing arrangement needs to be accommodative to the inflationary environment.
So Newman, if we drill down a little further, I mean, real estate industry is a very broad term. Given the conditions that you've described, the macroeconomic conditions that you are operating in right now, which sectors of the real estate industry would you argue would perform best in an environment like this?
Well, let me just predicate that by saying that if you look at the last few crises, take a look at the dot-com crisis of 2000, the global financial crisis of 2008. If you take a look at the number of quarters that it's taken for the real estate market or the real estate sector to recover, you're looking at a probably 16 to 30 quarters. If you take a look at what's happened now post-COVID, the real estate market has achieved a substantial recovery in only 8 quarters. So that shows that it's a robust sector. But in terms of particular segments within the real estate market, of course, the industrial sector is absolutely flying, both from an investment perspective and from a consumer demand perspective. You've got, and that's throughout Europe, the US, UK, Switzerland. We see in excess of $1 billion a year growth in that particular sector. In the office sector, we see a huge amount of capital flowing into the refurbishment of new offices. In terms of residential, in major cities throughout Europe, you have a structural shortage of residential. So we're seeing that in Portugal, we're seeing that in the United Kingdom, we're seeing huge institutional private equity flows going into residential developments.
There's some really interesting points being raised here. Just a reminder that you can always get in touch with us if you'd like to ask further questions on some of the topics being raised on Under the Macroscope. You can contact us via our website, www.skyboundcapital.com, or you can click on the links that appear at the side of the podcast here, and do get in touch with us. We'd like to hear your comments, and we will certainly pass the questions on. I'd like to pick up on what you said there about recovery post-COVID, and maybe ask you for some practical examples, because during COVID, Newman, we saw a number of individuals via their social media channels, a number of businesses suggesting that work from home was going to be the future. But I think there was very shortly after that a certain amount of fatigue around work from home, simply because of people's personal circumstances. And one could argue that for the effective operation of a business, for mental health issues, etc., getting out of home and into an office environment is preferable. And somewhere in between the two, there is a hybrid model. But I think it's fair to say, from what you've seen, and if I focus in particularly on your UK-based business, there really does appear to be appetite in the high-grade office space market in central London.
Absolutely, Matt. I'll say 2 things to you. Firstly, PwC, they issued a report, I think Q3 last year, that showed that if the demand for new office space fell to the levels we saw in 2020, there would still be a shortage of around 1.6 million square foot of office space in central London. Secondly, we see a substantial amount of capital flows going into that particular sector. There is a huge demand for Cat A plus office space. If you take a look at the take-up of 2021, 90% of the pre-letting in the London market was for Cat A offices. So you have a structural shortage of good quality office space in London. You've also got an increasing obsolescence of buildings. You've got thousands of buildings that need to increase their energy efficiencies and meet the new minimum energy efficient criteria that are coming into play in London in 2023. And all of that's really driving an investment into the sector. Secondly, there's a massive paradigm shift post-COVID. So pre-COVID and the whole story about work from home, I think is a dinosaur now. Everyone knows that that's not a reality. There's going to be a hybrid working model, but the predominant drive is for people to come into the offices, There's a huge focus on sustainability, on well-being, people wanting to create spaces for their staff that's aspirational, allowing them to be inspired at work. And I think that's the drive. And there's a lot of amounts of investment that's going into that particular sector. And that's something that we see. And we as a company have been focused in that sector since the beginning of COVID.
And also making provision for people getting to work via alternative forms of transport. So whether they're choosing to walk or use a bicycle, having facilities to be able to do that effectively.
Absolutely. So most of the buildings today have bicycle facilities. You're looking at outdoor areas or access to outdoor areas. Some of the buildings have internal gyms or F&B areas. The common areas, the stairwells and the lifts are all high grade, natural air ventilation, high quality conditioning, high energy efficient buildings. And I think that is the trend, and that is going to be a massive drive going forward in the UK market.
Is it fair to say, Newman, though, that it's not just a trend, it's actually becoming a necessity for a property developer? Just picking up on what you've said about carbon neutral buildings and this drive towards carbon neutrality, the importance for investment companies to have an ESG focus to their investments. It puts a lot of onus on property developers to develop in a future responsible manner.
Look, sustainability is one of the top items on the agenda as we're heading to the next couple of years. You're also seeing that if you take a look, there's probably around 27 million square foot of office space where the occupiers have signed up to some science-based targets, ESG targets. And I think that's pretty important because it means that there's an overwhelming drive. We're also seeing that, if you take a look at the kind of future occupational requirements in this particular sector, where there's going to be a focus on net zero carbon buildings, you're looking at a demand of around 15 million square foot versus a supply coming onto the market around 5.5 million, 6 million square foot of suitable accommodation in the next 5 years, which means there's a massive undersupply. It's also interesting to note that if you take a look at the assets that are energy compliant in terms of the premiums they're getting in terms of value, or the capital value per square foot, you're probably getting a premium of around 14% for BREEAM certified buildings in the City of London. And in terms of rental premiums for BREEAM Excellent, around 10% for BREEAM Excellent and about 6% for BREEAM Very Good. So that clearly indicates there's a premium to be had for those developers who are embracing ESG and are moving towards a carbon neutral world.
And I know in the not too distant future for you, you are planning to aggregate some of your developments into a structured fund environment. I mean, you're clearly seeing the opportunity here for real estate to remain an important portfolio diversifier.
Absolutely. I mean, just to say that in terms of ESG and the drive towards a carbon neutral world, as a company, we strive for BREEAM Excellence in the UK and the equivalent standards in Portugal and Switzerland. And as to your question, yes, we certainly believe that real estate as an asset class is an important part of someone's portfolio. We are in the process of setting up a development fund based in Luxembourg, a reserve alternative investment fund, which launches end of March. And that will allow some of our private clients to invest and have exposure to a diversified allocation across sectors and across geographies.
Well, Newman, fascinating to catch up, and we look forward to staying in touch with those projects in the UK, in Portugal, in Switzerland as well. We know there's a lot underway, and there's a lot more in the pipeline as well, which you can go and see at RE Capital's website. Fabulous to have you on the podcast. Remember that you can download the Under the Macroscope podcast on Google platform for Android, also on Apple and Spotify, and all past editions of Under the Macroscope are available at Skybound Capital's website, which is quite simply www.skyboundcapital.com. If you found today's topic interesting, please do get your responses and your questions to us. We'll make sure that they get to Newman and his team. And as I said earlier, we look forward to keeping in touch with you and your team on the progress of all those developments. Thank you for joining Under the Macroscope once again. Until next time, goodbye.